Welcome to Investing Insights. I'm your host, Ivana Hampton. How is the weakening dollar affecting your portfolio? The world's reserve currency fell sharply in the first half of 2025, making it a bruising year. It has recovered some, but still sits below where it started the year. Other currencies like the euro, Japanese yen, and Mexican peso look stronger against the greenback. Several factors could influence whether the dollar roars back or recedes. Why should the dollar's performance matter for everyday investors like you? Morningstar Indexes strategist Dan Lefkovitz is here to explain why and what you can do to protect your portfolio from currency fluctuations. Thanks for being here, Dan.
Always great to be with you, Ivana.
Let's start with an easy question. What's going on with the dollar?
Easy one. Well, it's interesting. If you go back 1 year to the U.S. election, November 2024, the dollar shot up, right? That was one of the Trump trades, so to speak. The market anticipated pro-growth policies, big spending, probably some inflation, interest rates, maybe that would stay higher for longer. But that rising dollar really reversed in 2025. So that Trump trade, really, I think the market kind of got wrong. In 2025, the tariffs have certainly unsettled folks about the dollar, debt and deficit concerns, tension between the White House and the Federal Reserve. Whatever the case, the dollar had its worst first half in the first half of 2025 for any year since 1973. So really fell versus major trading partners. It has rebounded since then, but it's still down for the year.
Now, I read your columns on Morningstar.com, and I recommend everyone listening, watching to read your columns on Morningstar.com. A lot of worried investors are likely asking the same question. How is the stock market going up in this macroeconomic environment?
Yeah, well, the stock market did have a wobble earlier this year between late February and early April. We had the Liberation Day tariff turmoil. U.S. market flirted with bear market territory, but yes, it has rebounded since then and has logged really nice gains for the year to date. And I think it's really AI enthusiasm that's powering the stock market. Now, I think there's a real tension, a real sort of struggle in financial markets between the bulls and the bears, between greed and fear. Stock market is definitely reflecting bullishness around AI, this potentially transformative new technology. And we're seeing, hundreds of billions of dollars in corporate CapEx go into AI. And that has boosted the earnings of companies that make chips and do data centers and, provide cloud storage. Where we're seeing the bearishness, the fear is in the currency markets. That's where folks are concerned about, all the stuff that we read about, all these risk factors out there.
And why are bonds doing well?
Yeah, I think the bond market is another area where we are seeing some fears and some concerns about economic slowdown. We've had interest rate cuts in 2025, weakened job market. This is another area, I think, where we've had a Trump trade reversed. After the election, bond yields shot up on expectations, perhaps, of inflation. We've seen them really come down. The 10-year Treasury yield fell below 4% in October. So I think fear sort of manifests in the bond market.
And you've written about the implications for the declining dollar. The dollar and gold typically compete as safe haven assets. And it looks like gold is winning this year. Why is that?
Yeah, well, the U.S. dollar has certainly benefited in the past from flights to safety, certainly appreciated during crises like 2008 and during the pandemic. This year, we have seen global central banks move out of the dollar and into gold as a reserve asset. They're perhaps concerned about, some of the factors that we've mentioned. The U.S. debt is in the neighborhood of 120% to GDP. Institutional concerns, tariff policy, certainly a factor. Geopolitics, I think, are another factor. After the Russian invasion of Ukraine, U.S. hit Russia with sanctions. Its assets were frozen, and it was seen by some as sort of a weaponization of the dollar. So we've seen governments around the world want to diversify away from the dollar. And gold, is a store of value that has been with us for thousands of years. Skeptics, say it's an unproductive unproductive asset. It doesn't have any cash flows associated with it. But clearly, people see gold as something that has value. And, in that sense, it does compete with the dollar.
Now, international stocks are outperforming U.S. stocks this year. How does currency play into this?
Yeah, as you've covered, Ivana, this has been a really strong year for international stocks, especially from the perspective of a U.S. investor who's holding shares that are denominated in appreciating currencies. So we've had the global ex-U.S. Index of developed and emerging markets equities outgain the U.S. market index, which itself has had a pretty strong year. It's up more than 12 percentage points beyond what the U.S. has returned. Now, those markets have done well in their own rights, but when you add in the currency effects, those gains have only been amplified from the perspective of a U.S. investor who's unhedged.
Now, our colleague, Morningstar Inc. portfolio strategist Amy Arnott joined me on the October 24th episode of Investing Insights. And Amy said that investors might be underweight in international stocks despite recent performance.
Mm-hmm.
Dan, what case can you make to convince folks to consider increasing their overseas exposure?
Yeah, well, we are definitely coming off a long period of U.S. exceptionalism in stock markets. We've had, these hyperscalers, these massive U.S. companies, the Magnificent Seven, and their ilk, just dominate global markets. I looked recently at the U.S. share of the global equity market value. It's over 62% compared to the share of the U.S. economy. And the global economy, it's only about a quarter. Not that those numbers necessarily have to align, but they just look really out of whack. I think currency diversification is definitely an argument for investing globally. But to me, the strongest argument is just opening up your portfolio to the full spectrum of opportunity. There's some great companies domiciled across the globe that have economic moats or durable competitive advantages around their businesses. Many of these are companies that we interact with daily, whether they're European pharmaceutical companies or Japanese electronics manufacturers or Mexican airports. There are even some nodes on the AI supply chain that are outside of the US, like Taiwan Semiconductor or ASML of Holland.
Now, emerging market debt is another asset class that's winning due to the dollar. Why does Morningstar consider this fixed income segment attractive?
Yeah, this is an interesting area, definitely a niche asset class that is quite highly correlated with equities as opposed to fixed income. It does have a lot of credit risk attached to it, but as a result, high yields and the potential for capital appreciation. As you said, this is an area that really has benefited from dollar depreciation, whether you're looking at U.S. dollar denominated emerging markets bonds or local currency. Our emerging markets bond index is up over 10% this year.
What risk could threaten the dollar's dominance in the future?
Well, folks are speculating now that the U.S. dollar's sort of status as the global reserve currency at the center of the international financial system is at risk. I'm not sure about that. I do recommend a really good deep analysis by our colleagues on the Morningstar Investment Management side, looking at a number of factors, some internal, some external, things like fiscal balance and trade balance and institutions and geopolitics. And they've determined that the dollar remains overvalued despite the depreciation that we've seen this year.
And why should everyday investors who are saving up for retirement or some other long-term goal care whether the dollar rises or falls, and how can they hedge their bets?
Mm-hmm. Well, we've seen in 2025 that currency dynamics can have an impact on investment returns. Over the very long term, currency effects have tended to come out in the wash for U.S. investors. There are some markets, some countries in the world that have seen really serious currency debasement, and folks have really been wiped out. And in those circumstances, it's really benefited investors to have currency diversification and global exposure. Now, I'm not saying that that's what's happening in the U.S., although, I will say that in 2025, we have had that term debasement bandied about. no matter what your view, I think it makes sense to have some currency diversification built into your portfolio. Currency, goes through cycles just like all market segments. We've seen periods in the past where the dollar has been really weak against major competitors, and it's really benefited U.S. investors to have currency, foreign currency exposure in their portfolio. Why not hedge your bets?
Thank you, Dan, for coming to the table and explaining why the dollar's performance matters for everyday investors.
Thanks so much for having me, Ivana.
It's time to check in with Dan Kemp about what he's tracking in the markets. Dan is the Chief Research and Investment Officer at Morningstar Investment Management Europe, and he writes the weekly Markets Brief column on Morningstar.com. Welcome back to the podcast, Dan.
Hi, Vanna. It's great to see you.
Awesome. So earnings season is underway. You've written about how it can be tempting to tweak a portfolio when companies share their forecasts. What should investors keep in mind?
Yes, of course. Well, earnings are really important. As an owner of a company, you need to know what management is doing, whether they're making good decisions. But the problem is that earnings season is on us every quarter, and the results tend to be quite short-term orientated, and that can encourage us to be short-term as well. But we know that true investing is always long-term orientated. And so don't use earnings season as a way to shorten your time horizon. Stay focused on the long term. If you're going to buy something at earnings season, make sure you'll be happy to own it for the next 5 years if nothing changes. And the same if you're selling it. Try to avoid that short-termism that comes with the latest set of results.
And in this week's Markets Brief, you wrote about how optimism about Tesla's unproven future growth opportunities highlights what's going on in the broader market. Can you explain?
Yes, of course. So we live in a time where it seems investors are very bifurcated in their views of the market. That if you're a company that seems to be a leader in the AI space, then there's a lot of optimism typically baked into your share price. So Tesla's a great example of this, that a lot of the value that people are ascribing to Tesla is actually for products, as you say, that are unproven or haven't been released yet even. Things like humanoid robots, AI testing, and of course self-driving cars. And so that's where there's tons of optimism. Equally, there's still parts of the market which are nowhere near the AI space where there's a lot of pessimism. And that's where the best opportunities tend to be for investors. It can feel great to be investing along with all the optimists, but really most of the value you're going to get as an investor is if you're looking at the undervalued, the unloved parts of the market.
And what are you keeping your eye on for next week's column, which I will point out will start off November?
That's right, already. Just 2 months to go until the end of the year. Well, there's loads to distract investors this week, which I'll be reflecting on. So we know that the Federal Reserve are going to issue their latest interest rate announcement. Everyone's expecting that to be a 1/4 point cut. It'll be a real shock if it's not. But even if it is the expected cut, then people will be watching closely what Fed Chairman Powell says in the press conference. Alongside that, it is Mag 7 earnings week. 5 of the so-called Magnificent 7, the sort of big tech companies that we've just been talking about, they'll be issuing their results this week. And so people will be trying to infer what the future holds for technology and the broader market. These stocks make up over 20% of the broad market. So people will be inferring what the future of the market will be. But again, avoid focusing too much on the short term, stay long term, and think about your long-term goals rather than what the market's doing over the next few days.
All right. So we're recording this on Monday, October 27. You got a sneak peek at what Dan is going to be thinking about this week and may appear in his Markets Brief column on Morningstar.com on Monday. Thank you, Dan, for sharing your perspective today.
Thank you. It's great to chat to you.
That wraps up this week's episode. Thanks for making this show part of your day. A couple of reminders. Give Investing Insights 5 stars on Apple Podcasts to help others find the work we're producing for you, and subscribe to Morningstar's YouTube channel to watch new videos from our team. Thanks to senior video producer Jake Van Kersen, supervising video producer Roberto Yakurchi, and associate multimedia editor Jessica Bebel. I'm Ivana Hampton, lead multimedia editor at Morningstar. Take care.